everyone, and welcome. Thank you for joining us for today's Meet the Analyst webinar, Retail Media, a closer look at our ad spend forecast and critical trends. I'm your host, Sky Cannabis, Senior Analyst at Insider Intelligence in Austin, Texas. And I'm joined by my colleague, Principal Analyst Paul Verna in New York. Hi, Paul. Great to have you here.
Great to be here. Thanks, Sky.
Before we get into the main presentation, I'd like to thank Ricoh for making today's webinar possible, and welcome Michael Green, SVP Global Vertical Strategy at Ricoh. Michael is joining us from Charleston, South Carolina. Hi, Michael.
Hi, Sky. Hi, Paul. Glad to be here today.
So a few things before we dive in. We have a ton of information to share, but there's no need to take notes. We'll email you a link to view the slides and the full recording. But we do want you to participate. Just use the chat window on the right to submit questions at any time during the presentation, and we'll get to as many as we can during the Q&A. So with that, Paul, let's get started. What's on the agenda today?
Yeah, well, thanks again, Sky, and thank you to everyone who's tuning in today. So here's what's on tap. We're going to kick things off with our latest forecast of U.S. retail media ad spending, and then we'll drill down on some other metrics, market drivers, and innovations in the space. From there, we'll segue to e-commerce channel ad spending, which is the biggest subset of retail media. Within e-commerce, we'll take a look at how it breaks down by ad format. Another important metric is overall e-commerce sales. So we'll take a look at our forecast and how it connects with retail media. And as we increasingly have to do these days, we'll do a quick survey of market stressors and how they may or may not impact retail media spending. And as always, we'll wrap up with some key takeaways and leave time at the end for your questions. And please do use the window in the lower right-hand side of your screen to submit questions. We always love to hear from you. Okay, so before we dive in, let's do some quick level setting on some of the terminology we'll be using today, just to make sure we have a shared understanding of what we mean. And by retail media ad spending, we mean digital advertising that shows up on websites or apps that are mainly engaged in retail e-commerce, or advertising that's bought through a retailer's media network or DSP. And a retail media network is simply an ad platform set up by a retailer to sell ad space on its website, app, or other digital properties. And that can include off-site touch points accessed through a DSP or partnership. So this is everything from the Amazon, Walmart, and eBay sites and apps to Amazon's DSP and Etsy's off-site ads. And it also includes ads that may not appear on e-commerce sites or apps. E-commerce channel ad spending is a little more narrow because it does not include advertising on social networks or search engines. It's limited to the retail media properties themselves. And retail e-commerce sales refers to goods and services ordered using the internet, regardless of the method of payment or fulfillment. And the fine print here is that it excludes travel and event tickets, payments like bill pay and taxes, money transfers, restaurant sales, food services, drinking and gambling establishments, and other vice goods. Okay, so with those definitions out of the way, let's crack open the forecasts and see what they tell us. I'll start with the big numbers. So this year, retail media ad spending will hit $40 billion in the US, and that's over 3 times the pre-pandemic total of $13 billion in 2019. By the end of the forecast in 2024, it'll reach 61 billion. And just so you know, when I cite figures, I'll use round numbers, but since you'll be getting this slide deck after the webinar, you'll have all the exact figures, and you can always ask us if you have questions about the numbers or about any other aspect of the deck. So the compound annual growth rate, or CAGR, for this forecast is over 35%, and the year-over-year growth rates in the red line will stay well in the double digits through at least 2024. And just to editorialize a bit, we don't often see this kind of growth, especially in a market that's already in the tens of billions of dollars a year. Now, another metric that's growing fast is retail media as a percentage of all digital ad spending. That's the blue line, and it goes from 10% to over 19%, so that's almost double in 5 years. And one more interesting tidbit about this forecast, which is actually not shown in the chart, By getting into this $60 billion range in 2024, retail media will be within striking distance of TV, which we're expecting to be around $65 billion that year. So just think about that for a second. Amazon launched its retail media network in about 2012, but the market didn't really kick into high gear for another few years after that. So we're really talking about an ad channel that's only been around for a handful of years, and it's approaching the scale of television, which has been with us for generations. And until fairly recently, TV was the single biggest category of ad spending. Now, speaking of TV, there's an interesting connection between retail media and connected TV, or CTV. They're the two fastest growing ad formats in the US, and their growth rates for the next couple of years will be almost identical. Here's what it looks like. So this is a year-over-year growth comparison with CTV in red and retail media in black. So in the first couple of years here, which are 2020 and 2021, growth rates were impacted by COVID, which basically had a boosting effect on both, but at somewhat different levels. Also, retail media was fairly new at the time, while CTV was more mature. So this is reflected in the early growth, with retail being ahead. But now they're both settling into that post-pandemic footing, and you can see that CTV is just slightly ahead from this year through 2024. So that means that technically retail media is the second fastest growing ad channel. And I say technically because there's a decent chance our outlook might change when we revise this forecast later this year, or maybe in the next update in early 2023. And if that happens, it's more likely to favor retail media. And why is that? Well, the turbulent market conditions that we're all facing are more likely to impact higher funnel, higher CPM ads like CTV than lower funnel performance-oriented ones like retail media. We've seen this trend in previous economic downturns, but we're also specifically seeing survey data from the likes of Advertiser Perceptions that indicates that marketers are most concerned about CTV ad budgets. And this is in response to inflation and supply chain issues. So while I'm not in a position to give guidance as to how or if we might revise these forecasts, it's not out of line to expect a slight adjustment. And if it happens, retail media growth could actually leapfrog CTV.
And Paul, how do retail media spending and CTV spending compare in absolute or dollar terms?
Oh yeah, I'm glad you brought that up. So in the first chart I showed, I mentioned that retail media ad spending was around 40 billion this year. And for comparison, CTV is just under 19 billion, so a little less than half. And again, that gives you an idea of how quickly retail media came out of the gate, so to speak. So we're talking about a nascent market that's already doubled a more established one like CTV. So that said, I'd like to shift to another comparison that puts retail media into a broader perspective. And internally, we call this next chart the third wave. And that's a nod to my colleague Andrew Lipsman's mantra that retail media is the third wave of digital advertising after search and social. So this shows you what it looks like when you stack all three, with search at the bottom in gray, social in the middle in black, and retail media up top in red. So this view is from 2019 to 2024. So it starts right when we began tracking retail media. At that time, it was a relatively small sliver compared to the others, but by 2024, you can see that retail media could actually catch up to social, especially considering the troubles that social platforms like Meta, Snap, and even Twitter have had. Search is still quite a bit bigger, but again, if current growth rates continue, we can expect retail media to eventually give search a run for its money as well. So let's look at the market leaders in each category and how much share they have. So this year, Google will make up about 56% of the search market in the US. Meta, despite all its recent struggles, will still capture about 3/4 of the market in social, and Amazon will do even better at 77% of retail media ad spending. So among other things, this chart is a good visual indicator of why we call these three companies the digital advertising triopoly. And just a quick note before I move on, there is some overlap between search and retail media in this chart, so the stacked bars are not meant to indicate the whole market size. Okay, so let's zoom in a bit on Amazon's share. I mentioned they're at 77% this year, and that's basically unchanged for the duration of this forecast. Now that would be a commanding share, even if it were something like a two-horse race, but it's more than that. There are many players scrapping for that other 20+%, like Walmart, eBay, and Instacart. Walmart is at number 2, but even its share is around an order of magnitude less than Amazon's. That's the black line. The same is true of the number 3 player, Instacart, shown in blue here. Now, it's interesting that both Walmart and Instacart are growing their shares, and we'll talk about them more in a minute, but let's also take a quick look at eBay. So its share will bottom out below 1% by the end of the forecast from almost 2% in 2019. And it's kind of hard to make out, but it's the gray line at the bottom there. And what's interesting about this is that eBay actually came out on top in our recent benchmark report, where we surveyed ad buyers on many attributes of 11 top media networks. And I wish we had more time to talk about that report because it's fascinating, but we have plenty to cover with our forecast, so let's continue. There's another metric where Amazon is far ahead of the competition, and that is average revenue per user, or ARPU. And a quick spoiler, by almost every measure of retail media success, Amazon lives up to its name by being the big kahuna in the space. But below the surface, there's an interesting data point about Instacart. So if you recall in the previous slide, Walmart was number 2 and Instacart number 3, and they each had about a tenth of Amazon's share. With ARPU, it's a bit different, where Instacart is second, and it has more than double Walmart's ARPU. So this basically means that Instacart has been especially effective in monetizing its retail media network. So let's stay on Walmart and Instacart for a moment. They're both doing a lot to build up their networks, and their ad revenues are growing faster than Amazon's. According to our forecast, Walmart's ad business will grow by about 58% this year, and Instacart's by almost 45%. So that compares to around 30% growth for Amazon's ad business. And here's a quick snapshot of how they're getting there. Walmart added video and in-store formats to its network earlier this year, and in July, it started a second price auction model. And that means that a buyer that submits a winning bid pays only 1 cent more than the next highest bid, regardless of the amount the winner actually bid. So basically, this prevents buyers from overpaying for inventory, and it increases their return on ad spend. And this is something that Walmart put in place in response to feedback from advertisers. Walmart also cut a deal with the Trade Desk to expand its footprint, and with Roku for shoppable ads. So in addition to organic growth, Walmart is making smart partnerships that extend the reach of its Walmart Connect network. Instacart also has big ambitions in retail media, with Fiji Simo joining the company as CEO in 2021. And Simo, of course, was a longtime Facebook executive who played a big part in building that company's ad business. All right, shifting gears a bit, at around this time last year, most US marketers who were using retail media networks were using 2 or 3. Very few were using fewer or more. And this data point comes to us courtesy of the Trade Desk. Now, I haven't seen an update of this, or I haven't seen other third-party research on the average number of networks that marketers are using, but I'm betting on this number going up. And that's because of a bunch of factors, like the number of new networks that have cropped up in the past year and the pace of innovation by all those networks. Also the specialization that a lot of them offer, and really just the amount of experimentation by marketers. Now, looking at the ad formats that retail media advertisers used in 2021, it's actually a mix, and really it's a lot of everything. So search led the way, which is pretty much in line with what one would have expected, but very close behind were display and banner ads. Now, given that our definition of display includes video, I wish we had a breakdown of how many of these advertisers were actually using video as opposed to, say, static display. We don't know, but it is worth noting that on-site video and CTV ads were also prevalent. And I should note that this data comes from our benchmark report, which I mentioned earlier, and it was based on a relatively limited number of marketers that we surveyed. So I don't want to present it as a barometer of the whole US retail media market, but it's still interesting that advertisers are availing themselves of a pretty wide range of ad formats on these networks. Now, another interesting takeaway from our benchmark report is that CPG marketers prized traffic scale and quality above all other attributes of retail media networks. Close behind were targeting, relevance, and first-party data. We'll get a little more into the importance of first-party data later, but together these findings drive home why Amazon is in the forefront of RMNs. I mean, after all, it offers all of these attributes in spades. So at the bottom of this list was offsite targeting via third parties. And this goes back to the fact that scale and a marketplace that includes a lot of those third parties are the most important considerations for advertisers, at least in the CPG space. All right, so having looked at our data and some third-party stats on retail media networks, let's step back for a bit and talk about some market drivers. So one of the biggest factors in the growth of retail media was the Apple privacy reset of last year, along with other signals that third-party identifiers are not going to look anything like they did up until recently. So this means that all of that first-party data that retailers already had in their possession suddenly became a lot more valuable, and the smart ones have been quick to monetize this data via their media networks. Another factor in the growth of RMNs has been the shift from physical to digital retailer that was already happening before 2020, but hit a peak during the first year of the pandemic, before vaccines, and when millions of people were staying home and shopping online. Marketers responded by shifting from in-store ads to digital ones, especially CPG companies. And related to everything that happened as a result of widespread shutdowns, when retailers lost all that foot traffic, they were really eager to find new revenue streams, and media networks were a logical step. And as an extra bonus for retailers, RMNs usually have higher margins than brick and mortar or even digital commerce.
And now, as consumers are returning to in-store shopping, what's the opportunity for brick and mortar retailers to bring retail media into stores?
I think brick and mortar retailers have somewhat of an advantage in that they have the in-store footprint in addition to whatever digital touch points they're using. And the network basically ties all of that together. So as more people come into stores, I think retailers are in a better position to use a variety of ad placements and formats to reach those consumers. So I think it is definitely a positive development, but obviously having the networks that they built in response to the loss of foot traffic in place is now going to be a plus. So we talked about some of the attributes of retail media networks, but there's also a lot of creative thinking happening in the space. So let's spotlight some of the innovations that we've seen in the last year or so. So I mentioned that Walmart added video and in-store ads to Walmart Connect, and that it launched a second price auction model. The grocery chain Kroger opened its in-house media network to third-party platforms. Amazon announced that for Q1 of 2022, its ad services revenue grew by 18% year over year, and that compares with about 7% growth in its top line revenue for the same period. And also in Q2, Amazon's ad business became its fourth largest revenue source behind e-commerce, third-party seller services, and web services. Ulta Beauty was among the latest retailers to launch a retail media network. Instacart added shoppable ads to its network, and some of the brands that first used these were Dove, Mondelez International, PepsiCo, and San Pellegrino. The grocer Albertsons partnered with the Trade Desk for audience verification and measurement, and if we're dropping names of marketers and agencies that are part of this effort, here it's PepsiCo, Unilever, and Group M. And one more innovation I'd like to highlight is that non-retail players are also getting into media networks. And some of the more high-profile ones that have done this recently are Marriott and Universal Music, but I expect more of this in the coming months and years. And speaking of what we might expect, there's a lot that's likely to happen in the last few months of the year, but here are two items that I'd like to touch on. So this week, Amazon will start streaming Thursday Night Football under an exclusive license with the NFL. And this is a big deal in sports broadcasting, mostly because of the exclusive nature of the license. Up until now, most of the major games on streaming services were also available on broadcast or cable networks, so it was more of a simulcast scenario. But this time, people who want to watch these weekly games will essentially have to do it on Amazon Video. But the reason I'm bringing it up here is that this development could have implications for Amazon's retail media offering. For now, it's really more about a TV-like experience, and everything about these NFL streams will mirror what people are used to on traditional TV. But it's not hard to imagine Amazon connecting the dots between this video opportunity and its broader retail media network. And by the same token, Amazon will also be looking to do this through other streaming platforms like Freevee and Twitch. So the other big event that's likely to happen in the next few months is Instacart's IPO. Now, with all the market uncertainty and drops in valuations, this has not been a great year for IPOs, but Instacart has stayed mostly above the fray. They reported big audience growth in Q2, so this could pave the way for a late 22 or early 23 IPO. All right, so before I move on to e-commerce data, I'd like to spend a minute or so on highlights from a McKinsey study. And this looked at trends and opportunities in retail media. So first, they found that almost all US advertisers who use retail media networks used at least one network other than Amazon's. And this is a sign of an expanding market and a lot of experimentation. The study also found that CPGs are the biggest users of retail media, which we knew, but other industries like jewelry, consumer electronics, and beauty are also planning to increase their investments in the format. And here's a really interesting one. 80% of retail media dollars are incremental, according to the study. So this kind of busts the myth that network ad spend comes from money that retailers are already earning. Another one that sort of cuts against some of what we know about retail media is that advertisers are just as interested in using the networks for brand building as they are for performance. And finally, self-serve capabilities are sort of a nice to have, but ultimately they don't really move the needle for ad buyers. All right, so let's move to the next topic, which is e-commerce channel ad spending. So for starters, e-commerce advertising is the largest subset of retail media. As I showed in the glossary at the beginning, the difference between them is simple. Retail media includes retailers' DSPs and other extensions of the retailer's presence in social channels or search engines, while e-commerce ad spending is limited to retailers' sites and apps. But they track closely together, with e-commerce ad spending hitting about $36 billion this year. And if you recall, retail media is at about $40 billion, so it's not a huge difference. And the other metrics are similar as well. So growth will be in the solid double digits for our whole forecast. And this one actually goes out to 2026 instead of 24. And ad spending as a percentage of digital in that blue line will also scale from around 12% to 20%. Now, the e-commerce ad channel, and by extension, retail media, leans very heavily towards search. That's not a big mystery given the tight connection between product searches and retail ads, but it's interesting that the mix between search and display won't change much during our forecast. Search makes up roughly 3/4 of the total. And I say it's interesting because there's a lot of talk about the promise of CTV and retail media channels, including in this presentation. But the data reminds us that at its core, retail media and e-commerce advertising are still mostly about monetizing product searches, and that's not likely to change anytime soon. Okay, moving on to the other related metric, let's take a look at retail e-commerce sales. So this also correlates closely with retail media. It's hard to imagine one going up without the other. US consumer spending on e-commerce will top $1 trillion for the first time ever this year, on its way to over $1.6 trillion in 2026. And year-over-year growth will be in the double digits starting next year. In fact, growth will accelerate during the forecast. Now, we don't have time to go into a breakdown of spending by vertical, but every product category we track, including apparel, consumer electronics, and furniture, is going to see plenty of growth in e-commerce sales. Okay, so that brings us to the final part of the deck before the takeaways. So this will be a super quick overview of market conditions or stressors and how they might act on retail media. So I'll start with inflation. I mentioned that this is more likely to hit upper funnel ads first. So unless we go into a protracted period of rising prices, I don't think retailers need to worry a lot about a hit to their media businesses. As far as supply chain disruptions, we did actually make a slight downward adjustment in our retail media ad spend forecast, partly in response to this factor early this year. But again, unless the problem persists for a very long time, the effect should be contained. Now, we've seen a lot of retail and tech stocks get battered this year. Companies that have struggled like Target, Bed Bath & Beyond, and Wayfair are down significantly year to date in terms of their stock prices, as are Amazon, eBay, and Best Buy. Even Walmart, which has been one of the better performing retail stocks in 2022, is still down year to date. Now, that said, valuations aren't necessarily going to determine whether a retailer invests in a new or existing media network. In fact, you could argue that the more distressed a retailer is, within reason, the more they need that media revenue. So again, a lousy stock market alone won't pull down retail media advertising. Now, this being a US focused report, I don't expect the Russian war in Ukraine to have a significant effect on retail media spending in the States. Like a lot of these factors, if it gets worse or goes on for a very long time, the ripples could touch retail ad spending here, but there's nothing to suggest that this is going to happen imminently, if at all. Rising interest rates aren't likely to suppress retail media spending, but they could slow down the pace of new investments in the space as borrowing costs continue to go up. Then there's the R word, and it doesn't stand for retail, but recession. So if the economy is already in a recession or goes into one, how that's felt in the ad market will come down to how long and how deep it is. But even in a hypothetical recession, other ad budgets are likely to get cut before search and retail. And the last factor here is the one that overrides the others, and that's retail e-commerce spending. So as long as people are shopping and purchasing online, they will be a captive audience for brand marketers trying to reach them closest to the point of sale. Right now, we don't see macroeconomic headwinds slowing down that trillion-dollar engine of e-commerce spending. So we feel pretty confident that retail media will weather this storm. All that said, I do need to sound a note of caution here. So the factors I just outlined have the potential to compound each other. So for instance, interest rates tend to seesaw with inflation, but they track with unemployment. So something has to give. And if the Fed doesn't get the balance right, the ad market could take a bigger hit than what we're anticipating right now. Also, lots of retailers have found themselves with excess inventory because of supply chain disruptions. This could actually be a short-term gain for advertising if retailers or marketers are trying to move inventory out of stores and warehouses, but in the long run, it's not great for the ecosystem. So the bottom line here is retailers and marketers should tread very carefully in this environment. Okay, so that brings us to our takeaways. Retail media is the second fastest growing ad format, very closely behind CTV and with the potential to surpass CTV. The past couple of years have been a sort of perfect storm for retail media. There was already momentum behind this ad channel, and the pandemic accelerated it. At the same time, Apple's phase out of mobile identifiers and Google's planned cookie phase out put a premium on the troves of first-party data that retailers already had. And this perfect storm has led to a wave of investment and innovations with new networks, partnerships, and features cropping up seemingly every week. Today and in the next few years, retail media will be mostly search-driven, but there are indicators that connected TV could be the next frontier for networks that are aligned with streaming services. Macroeconomic conditions have not been kind to tech and media, but retail ad spending has pretty much stayed above the fray, at least for now. So with that, I'll hand it back to you, Skye.
That was great. Thank you, Paul. So before we get to your questions live, we're now joined by Criteo's Michael Green. Welcome, Michael, and thanks again for being here.
Thanks, Guy.
So my first question for you, Michael, is spending on digital retail media networks and the e-commerce channel is growing faster than that of every other ad format we track, with the exception of connected TV. Is this consistent with growth trends that Criteo is seeing?
Yeah, absolutely, Sky. So for a bit of context, our technology powers the retail media networks of over 160 retailers globally. So while we don't have the same visibility into players like Amazon or Walmart's US business who have built their own in-house tech stacks, we have a pretty good representative sample of the broader swath of the industry. And look, as a publicly traded company, you can look up the numbers themselves, you report our retail media numbers, but we've seen consistently strong double-digit growth for this business over the past couple of years, completely consistent with the trends that Paul described above. I think one of the interesting trends that we're seeing as well is, as Paul mentioned, the flight towards diversification. As I mentioned earlier, we have a very large number of retailers in our ecosystem. And especially if you look at the larger global brands today, diversification is a core part of their strategy. We pulled our own numbers, and if you exclude the very, very small advertisers that we work with who tend to only spend on one individual retailer, primarily only sell through one individual retailer, we're seeing the rest of those advertisers spend on 2.5 retailers on average. And for the largest advertisers, that number is well over 4. So increasing diversification as well as larger budgets are certainly trends that we're seeing in the space right now, consistent with many of the things that Paul had noted in his presentation.
And so what do you think about that data showing that brands typically work with 2 to 3 retail media networks? Do you see fragmentation as a real issue, or is there more consolidation on the horizon?
I think as I speak to brands, and especially their agencies right now, fragmentation is the challenge that comes up again and again and again. So if you take your typical agency, right, who's representing a brand, that brand maybe sells at a dozen, 15 different retailers in a given market. Multiply that by multiple countries, and then multiply that in the case of many retailers across different technology stacks that power things from on-site search to on-site display ads to even off-site programmatic, as Paul has mentioned, as being part of what Walmart, Amazon, and many other retailers are doing today. And you can pretty soon add up a lot of different reports, a lot of different UIs, a lot of different salespeople to deal with. And I think if you add together some of the numbers that Paul showed and some of the things we see in our own data, that problem is only going to get worse as advertisers begin to invest across a broader swath of retailers. A big part of our focus from a technology perspective right now is to solve for that fragmentation by normalizing workflows, creating more consistent reporting across retailers, and trying to aggregate and normalize as much as possible to simplify things for advertisers. But certainly as this ecosystem expands, creating more normalization and regular paths of working across more retailers is going to be absolutely essential if we're going to see these growth rates continue at these current levels, because at some point brands are going to spend on more and more retailers. I think you see that with Amazon's growth numbers slowing a bit for its ad business. And as we look at that, solving the fragmentation challenges is going to be absolutely be essential.
And our projections show search ad spending growing at almost the same rate as display ad spending. Is Criteo seeing a similar trend?
Yeah, I think it might look a little bit different in our own business, largely because our legacy was on the search side of the business, and display has been a more nascent channel for us over the past couple of years. But as we look at the retailers that work with us from a technology perspective today, we see different patterns geographically and different patterns by sector. In the US, we tend to see a very search-heavy market. I think this is driven by the fact that it's a more advertiser-facing market than maybe in Europe, which is a bit more retailer-dictated in terms of the experience for the advertisers. And being that the retailers in the US especially want to create a very attractive environment for those brands, search has been at the forefront of their programs, and gradually we see display and especially on-site video becoming a bigger part of their strategies. In Europe, especially Southern Europe, we've seen display really be the foundation of many of those businesses. Think about it in a lot of ways. Retailers try to translate what they built maybe in a physical brick and mortar store into the digital world. I think as those retailers mature, as retail media starts to become a bigger share of their business, we're going to see more of an even split of those businesses between search and display as they try to introduce a broad array of ad offerings that are highly attractive to brands and can reach customers at different parts of their shopper journey. I think as a whole, we've often seen retail media as very much a bottom of the funnel type of marketing avenue. And I think that ability to measure results of retail media to sales is never going to go away. What I anticipate going forward there to be is greater sophistication of brands looking at how offsite programmatic, on-site display, on-site search all interact together for the benefit of driving what every brand cares about, which is moving products off the shelf and gaining share of category.
Yeah, those are great insights. And are you seeing any other trends that are having an impact on brand and retailer relationships?
Yeah, I think there's a couple things that stand out to me. One, brands looking to bring more organic insights together with their media insights. If I look at how retail media has grown over the past few years, historically, oftentimes marketing teams were taking this on almost as a silo, independent of a lot of the efforts they were doing on the product sales side that was looking at things like share of category, share of shelf, health metrics for their business. I think going forward, we expect brands to begin to look at their relationships with retailers a bit more holistically and try to more tightly connect the marketing and sales sides of those businesses. To that end, we've been investing a lot in how we bring additional insights that pull not only together ad-related data, whether that's impressions, clicks, ROAS, but also beginning to bring in organic data to layer on top, looking at things like, hey, what is your share of sell for a particular category? And how could that influence where you decide to allocate budget as a brand? To this end, we see many of the more sophisticated brands we work with build more holistic commerce teams that are looking not just at retail media spend, but all aspects of their relationship with a retailer, whether that be product content, position on the shelf, supply chain, and begin to orchestrate all of these holistically with the end goal of moving more products off the shelf and keeping shoppers happy.
Thank you, Michael. Now it's time to get into our audience Q&A. We've received a lot of great questions, and I'll start with one for Paul. You mentioned that traffic scale is the most important attribute of a retail media network, at least for CPG marketers. Do you have a sense of how much scale a network needs to be successful?
I don't think there's a magic number. I think scale is relative to the type of retailer, whether they have in-store footprint or they're D2C. There are a lot of factors that come into play. At the end of the day, though, any CPG is going to need an audience of a size that it considers worthwhile to serve ads to. But I don't think there's like a specific, like a bar that they have to cross where they say, okay, unless it's 100,000 impressions or 1 million plus, it's not worth it. Because I think in some cases the audience is narrow, it's more of a niche audience, but if you can reach them in a captive environment where that they're interested in the product, then that counts for a lot as well.
Okay, and my next question is one for Michael in terms of what are the brands and retailers you're seeing that are growing fastest in this space, that are doing the best?
Yeah, so let me start and talk a little bit about what we see on the retailer side. I think one of the things that stands out across all the retailers we work with that are growing relatively quickly are two things. One, they're trying to be as advertiser friendly as possible. And that seems obvious, but it's a real change in mindset for many retailers. If you think about the traditional retailer brand relationship, the retailer was always the customer, right? They bought goods from the brands and sold those to the end shopper. But that mindset has to switch a little bit once you start to sell ads, right? The brand really becomes the customer. And that's something we see a lot of retailers adjusting to. It's a different power dynamic with the brand and a different way of working. So being as brand friendly as possible, again, going back to easy to buy through aggregation, normalized metrics with the rest of the industry, providing flexibility and control to the brand are things that stand out amongst retailers that are growing relatively faster than the rest of our retailers, at least within our ecosystem. I'd say the second thing that stands out for retailers that are growing faster is, simply put, they're adding more inventory. One of the biggest challenges for retailers is always navigating the trade-offs between building an ad business and creating a great shopper experience that drives organic sales results. And I think the retailers that are growing the fastest are finding ways to get that balance right, and maybe even leaning a little more heavily on getting aggressive with ads. We've seen some of our smartest retailers do things like apply advanced audience analytics to understand the purchase propensity of a given user. And if they're a low purchase propensity customer, maybe load them up with a higher ad load than those that would be closer to their end goal of buying products. So I think we're seeing retailers gradually over time get a little more aggressive in creating higher ad load. They're following the lead of industry leaders like Amazon, who have for the last few years been pretty aggressive at putting lots of ads on the page. And At the end of the day, as Paul said, scale matters, and you can't get scale unless you have a lot of ads. So certainly a trend we see. On the brand side, I think the trends that we see amongst the leaders are those that are constantly asking the question, what would be true to make us spend more? How do we do that while still maintaining effectiveness? I know that's the question that our account managers get constantly. And I think that goes back to my earlier point where the ones that are spending the best and smartest and the most and scaling most effectively are doing a couple things. One, they're looking at commerce holistically, not just retail media in a silo, and figuring out how paid media interacts with all other elements of their relationship with the retailer. But they're also planning retail media within the context of their broader marketing plans. So we see two areas of convergence happening with the leading brands in the space. One, all elements of commerce coming together, retail media and some of those more organic sides of the retailer relationship, but also retail media as it becomes a bigger share of the overall brand marketing spend, becoming planned as part of the bigger planning process that advertisers go through alongside TV, CTV, and other digital channels.
And in line with that question, perhaps for both of you, what data or sense do you have on shifts of budgets from search to retail media?
I don't know that we have data that specifically tracks budget shifts, but I mean, you know, search and retail media are obviously very tightly wound together. You know, I know we talked a little bit about market conditions and how they affect budget allocations, and some of the survey data that we've seen shows that obviously, you know, marketers and agencies are looking to maybe cut back on some of their higher CPM and higher funnel budgets. But at the end of the day, I think it really does come down to e-commerce activity, and the more of it there is, the healthier that market is, the more the retail media network space, you know, that boat is going to rise along with it. But I don't know that there's like a tremendous, you know, like shift in budget allocation specifically from search to retail media. I don't know if Michael, if you have more insights into that.
Yeah, Paul, I think the thing we probably pay the most attention to is allocation from shopper and trade marketing channels into the retail media sector. And I think there's a lot of conflicting information out in the ecosystem. I think, you know, probably most prominently, McKinsey published a number saying that a vast majority of retail media spend is actually incremental. So those trade and shopper dollars, I think as you talk to a lot of retailers, they might be a bit more suspicious about that number. And I think it really does vary significantly brand to brand. Over the past 2 years, I've heard a wide variety of funding strategies coming from brands. I think one of the things we saw early on in 2020, as every marketer in the world was really looking at a brand new commerce environment and considering, where do I spend my next dollar? I think we heard more of a flight, not just from physical retail environments, trade and shopper funds, as you would expect when all the physical retail stores were closed, but also people taking from maybe more traditional channels such as social. If you look at the largest retail media spenders today, they tend to be in the CPG category. And by and large, these were never big paid search spenders, right? Didn't have a big direct to consumer business by and large, tended not to be very direct response oriented in their marketing approaches. So as I look at budget shifts, I think it's coming from across the board. Yes, there's inevitably some from trade and shopper, just mirroring consumer behavior from physical retail into digital. I think we're seeing a bit of a flight back into physical retail in light of some of the more recent developments in our economy, but also shifts in budget from more traditional channels, whether that be CTV, social, display, but also just a lot of net new money flowing into the space because it represents a net new advertising opportunity that's incredibly powerful from a data and proximity to purchase perspective.
So we have a few questions asking more specifically about that CTV. One is, can we talk a bit about how retailers might use CTV in their media networks?
Yeah, I mean, you know, I mentioned Amazon, and they're the obvious leading candidate here to really leverage those two channels together. I mean, Amazon, I mean, they have freebie ad-supported streaming service, they have Twitch, and now they're doing all this NFL stuff, and they are very likely to go deeper into live sports. So they're basically creating a lot of new inventory that's obviously much higher funnel connected TV inventory. But because of the way Amazon is so clever at leveraging all of its businesses together, it's not too hard to envision how they might, basically use connected TV within its retail media network. I think we're also seeing, Kroger has a deal with Roku, and that's aimed also at basically Kroger reaching some of its customers through connected TV platforms and media. So I think there's going to be more of it. Right now it's more about experimentation than about actually a large amount of advertising flowing into retail media networks, through basically CTV. But I think we're going to see more of it over time, as marketers basically start to expand outside of like that traditional, product search type of environment that retail media networks offer right now.
And there was an Amazon specific question about in the forecast whether Amazon CTV advertising was counted as CTV or retail media network.
When we talk about Amazon's ad business, it's everything. So that we're not delineating it specifically around CTV or retail media. There was the slide that I showed that stacked retail media with social and search, so that's a little different. But regarding CTV specifically and retail media, we don't have a way to differentiate that. So when we look at CTV, any ad that's basically going through CTV platforms, including Amazon's, is going to count towards CTV. But Amazon is obviously also injecting a lot of revenue into the retail media market. So it's basically, I would say Amazon is feeding both of those curves that we showed in comparison with each other.
And our next question is one I think both of you can weigh in on. That's, aside from needing to have scale, are there types of retailers that have an advantage over others when it comes to their media networks?
Well, I think the in-store footprint only helps, but it's not a deal breaker. You see a lot of retailers that are digital first that are, leveraging their properties for retail media. I think at the end of the day, it's more about the audience, how captive the audience is, and how desirable in terms of, advertising. I think Michael's point about propensity to purchase is really interesting because it shows just how sophisticated retailers are about serving those ads, and that can be any retailer. So obviously, the more scale you have, the more touch points you have, the more you're going to be able to build a network that is wide-reaching and sophisticated. But it doesn't have to be if your audience is engaged and if you are savvy about how to market to them.
Yeah, I agree with everything Paul said. I think when we look at the market opportunity for any given retailer, we think it's largely tracks with gross merchandise value. So if you're selling products, there's a retail media opportunity for you. Right now, I think we look across the ecosystem, many retailers are only beginning that journey. As Paul mentioned early in his presentation, this is a young space, right? And as quickly as it's growing and as much scale as we see right now, many retailers are only at the beginning of that journey. And I think what we'll see going forward is more ad inventory, wider degree of formats, better use of audience data, more flexibility of measurement, and all of that will increase the opportunity, not just for the largest retailers, but for the mid to long tail of retailers as well.
There's a question about a slide from our benchmark about the features that marketers look for in a retail media network. Our audience member asked, I'm wondering why attribution wasn't one of the ones that rose to the top. Paul, what do you think?
Well, first of all, the chart that showed the attributes, a lot of them were very, basically they're all important. It's just like there are fine points of, decimal points, percentages that separate them. So the fact that I didn't specifically call it out because it was maybe closer to the bottom doesn't mean it's not important. It's not only important, but I think it's almost table stakes. And in a way, I think marketers take for granted that if they're advertising in retail media environments, that attribution is part and parcel of that. So I think it's very important. It's just that some of the other factors like scale, those are things that you need in order to get to attribution. At the end of the day, it's about return on your ad investments, and attribution is obviously how, one of the ways that you're going to measure that.
So we have time for one more question, and I think this is a good one to conclude with. When do you plan to update your retail media ad spending forecast? And do you expect any big changes from the current one?
Yeah, well, this is a forecast that we update twice a year, and typically that happens around March and October. So the next update is coming soon. Like I said earlier, I don't want to commit to saying, how or if we're going to change the outlook. I don't get the sense, though, from speaking with our forecast team and just from what I observe from the space, that there's going to be like a dramatic shift in how we're looking at it. I think we have priced in a lot of the factors that weigh for or against retail media. Generally, it's all favorable. So I think the percentage increases that we've seen are going to hold for the most part. Like I said, there might be a little bit of adjustment because that comparison I made with CTV, because the growth rates are so close to each other, any tiny shift could tip one, to tip the scale in favor of one over the other. But overall, unless there's something dramatic that happens between now and the end of the year, I really don't think we're going to see a dramatic change in our forecast. And I would say the same for early 23. It looks like the market is kind of stabilizing and settling a bit. So, never say never, but I think the forecasts that I showed are likely to be pretty robust, at least for the foreseeable future.
Well, thanks for sharing that look ahead. And unfortunately, that's all the time we have for today. Thanks again to Paul for joining us, and a very special thanks to Michael and to the team at Ricoh. Our eMarketer production crew behind the scenes also deserves a huge thank you for making this webinar possible. And as promised, we'll be emailing you soon with a link to the slides and full recording. But before we wrap up, let me take a moment to tell you what's happening across eMarketer's media channels. You can register for upcoming live Analyst and Tech Talk webinars at eMarketer.com/webinars. On the audio side, don't forget to tune into Behind the Numbers, eMarketer's daily podcast, wherever you listen to podcasts. And finally, please check out our newsletters. Thank you for joining us, and enjoy the rest of your workday.